We are in the calm before the recession storm. At least that's according to Jamie Dimon, who is the CEO at JP Morgan Chase Bank. Every year, JP Morgan puts out their own annual statement where they talk about their opinions of what's going on in the economy, their worries about the economy, what they think is coming in the economy, and then Jamie Dimon also releases his own letter to shareholders. And for this year's letter to shareholders, which I've already read and gone through, he talks about some of his concerns about the economy and why he says this banking crisis that we're facing is going to have bigger consequences that we have yet to face, and that we have now higher odds of a recession. And so I've already gone through this annual report and analyzed. If you want to read it for yourself, I will also link it for you down in the description. But what I want to do is start by talking about what Jamie Dimon's concerns particularly are regarding the banking crisis. I want to talk about his opinions about consumers and spending and inflation. And then I want to talk about third, which is what is the way to fix this and our economy and what's coming. So let me start by talking about his concerns about the banking crisis. And let me start by giving you a quote by Jamie Dimon himself. He says, "As I write this letter, the current crisis is not over yet. And even when it is behind us, there will be repercussions from it for years to come." The reasons why he is saying this is because, we saw some banks fail, but that's going to have more trickle-down effects. The first trickle-down effect is that people are moving their money from some banks to other banks. We've been seeing people move their money from smaller regional banks to some of the bigger banks, where many people are now calling this like a consolidation, where we're going to see a few mega banks in America and much smaller amounts of regional banks, because Janet Yellen, who's a Treasury Secretary of the United States, essentially came out and said that she'd be willing to bail out depositors because FDIC insurance protects your savings up to $250,000. Well, when the Silicon Valley Bank crash happened, they extended that FDIC insurance to essentially infinity. And so when everybody was wondering, is this going to continue, this unlimited FDIC insurance, Janet Yellen essentially said, no, this is not going to continue, but we will protect depositors if a bank failure would cause pandemonium and further contagion in the banking sector. AKA, the way that many people interpreted that is that if a bank is very big and they fail, you will get bailed out. If the bank is small and they fail, you will not get your money back. So that triggered a big, almost panic, where some people went to their local regional banks and started pulling their money out and started pushing it and moving it to the bigger banks. And that's when Janet Yellen kind of walked back on her word, where she said that we're going to do everything that we can to protect all depositors. What does that mean? Nobody knows. So this is where the first confusion really came in the banking sector, because people didn't really know what is going to happen if other banks failed. Now, the interesting thing is Jamie Dimon actually talked about how this banking crisis has benefited bigger banks like JP Morgan Chase Bank. Let me read you what he said. He said, "While it's true that this banking crisis benefited larger banks due to the inflow of deposits they received from smaller institutions, the notion that this meltdown was good for them is anyway absurd." AKA, we're getting a lot of money into our bank, JP Morgan Chase Bank, because people feel safer at our bank. But the issues around the banking sector are still there, because people are worried. And when people are worried, they're less likely to spend. And when people are less trustworthy of banks, that's not good news for everybody. So that's what Jamie Dimon of JP Morgan is saying regarding the banking sector. But then he goes on to talk about the impacts of this banking crisis. And there's a couple things that he said. First, he said that the odds of a recession have increased because of this new banking crisis. Why have the odds of a recession increased? Well, we're seeing the credit crunch. We're seeing the higher interest rates. Both of these things are having an impact in addition to everything else that we've been seeing happen. We still have high inflation. This high inflation hurts the middle class. It hurts people's ability to spend. It hurts people's ability to pay for their rent or their mortgage and their gas and their groceries. And so people have to cut back on their spending. When people cut back on their spending, they have less ability to buy discretionary things, meaning when you go to the mall, you can't just go and buy a hat or a Gucci belt like maybe you could have before, which means that these businesses make less money. When these businesses make less money, they make smaller profits, which is not good news for these businesses. And so now we had that already happening with the higher interest rates. Then came on, the high inflation. Then came on the higher interest rates by the Federal Reserve Bank to bring the inflation down. The Federal Reserve Bank saw how bad this inflation problem was, and then they started raising interest rates. Now, at first, it didn't really cause that much pain in the economy. And the Federal Reserve Bank was hoping that they would be able to break inflation before they break the economy. And so over the last 12 months or so, the Federal Reserve Bank has been working steadily to increase interest rates to reduce demand as a way to bring inflation down. Well, one of the consequences of the higher interest rates was that bond prices fell. And I'll get to what that means in just a second. And many of these banks, including Silicon Valley Bank, were big owners and investors in the bond market. Now, as interest rates went up, bond prices went down, which meant that you had banks like Silicon Valley Bank, which was underwater heavily on their bond investments. So when you loan money to the government, this is called a treasury loan. We covered all of this in Market Briefs. We did a full deep dive. So if you've already read Market Briefs, you should know what I'm talking about. If you haven't joined Market Briefs yet, it's the free newsletter where my team is breaking down what's happening in things like the economy, the stock market, the housing market, crypto, and the global economy into a fun, witty, and easy to read email. It's a simple newsletter that keeps you up to date on what's happening and is completely free. So if you haven't joined Market Briefs yet, I got the link to how you can join down in the description below. So the government offers the ability for regular people like you and me, to loan them money and invest our money. And in exchange, we get a guaranteed rate of return. It's known as the risk-free rate because the government always pays their bills. Now, how does the government always pay their bills? Well, they have the ability to work with the Federal Reserve Bank to print money, which means if the government has a bill to pay, they can get the money printed and pay the bills. So the government has the ability to always pay their bills, which is why when you loan money to the government and you get this interest rate, that is known as the risk-free rate. So loaning money to the government is considered a risk-free investment. And what we saw happen was, particularly for Silicon Valley Bank, they had loaded up on some of these treasury bonds. Now, as interest rates went up, the prices of bonds went down because they have an inverse correlation. When the government is essentially incentivizing you more with a higher interest rate, the price of the bond goes down. And so as interest rates went up over the last year, the price of these bonds went down. Silicon Valley Bank was a big holder of these bonds. So now Silicon Valley Bank saw their yields go up, but the prices of their investments went down. And then because of the panic and the worry that in the people who had their cash, the businesses who had their cash at Silicon Valley Bank felt, they started pulling their money out. And now all of a sudden Silicon Valley Bank was facing a almost overnight credit crunch because people were pulling their money out. They didn't have any assets to sell to gather more cash. They couldn't raise more money, and then they were forced to shut their doors. So now we have the high interest rates, the high inflation, and then we have the worries in the banking market. And then we're also seeing the slowdown in the economy, which, some months is slower, some months is better, but we're seeing all these things coming together. And now, especially with the banking crisis, this is where Jamie Dimon from JP Chase Bank is saying that the odds of a recession have increased. How bad will it be? Well, if you look at what Jamie Dimon says, he says, quote, that this is nothing like 2008. He says that yes, we have issues in our economy. Yes, we have issues in the banking sector. Yes, we have issues with inflation, but we don't have the same credit and liquidity issues that we did prior to 2008. So according to Jamie Dimon, we have a lot of issues with the economy, but it's not going to cause a major recession. Now, he did mention that there's a lot of uncertainty as to how bad it will be and that things can take a nosedive very quickly. But based off of the information that we have today, he says that we will likely see a recession, but that it won't be like a 2008 recession. He's saying and kind of hoping that it's going to be more of a mild, soft landing type of recession. So that's what Jamie Dimon said about the credit crisis. Then he switched gears and talked about the consumer and spending. And this is really interesting because according to the data from JP Chase Bank, and they probably have some of the most accurate data on spending because a lot of people bank with Chase. And even if you don't bank with Chase, you might have a Chase credit card. So they know what people are doing because people have their money at Chase or because they're spending on their Chase card. And what they said is that consumers have been spending 7 to 9% more than in the prior year and 23% more than pre-COVID-19. Now, the reason why this is significant is because one, we're seeing people spending way more now than they were prior to the pandemic, and they're spending way more now than they were just a year ago. Why are they doing that? Not necessarily because they're getting more things, but because the prices of things have grown so much. In fact, for the average person, the amount of things that you can buy today with your salary is less than what it was prior to the pandemic. Why? Because of inflation. And more notably, if you look at what he says that consumer spending has increased 7 to 9% more than the prior year. Which means if the average person is spending 7 to 9% more today than last year, and your wages have not grown by 7 to 9% since last year, you are effectively poorer today than last year because you have less income relative to how much you're spending. And we've seen incomes rise between 4 to 6% over the last few years, year over year, which means, yeah, we've been seeing incomes rise, but people are spending faster than what their incomes are growing at. That's not good news long term because, yeah, maybe in the short term you can spend more because you have credit card debt, you have access to savings, but eventually if you keep spending more than what you're earning, you're going to hit a breaking point. And this is what Jamie Dimon talks about because he said that according to our own analysis, so this is JP Morgan Chase Bank's analysis, they say that $1.2 trillion of excess cash in checking accounts are still there than before the pandemic. Meaning people still have excess savings to spend. Now, this is where it really pays to understand how our economic system works because our economic system runs on spending. The more money you spend, the more money somebody else makes. If you got $100 because you went to your job and you earned $100 and you put that money in your pocket, it doesn't really do any good for the economy. Yeah, maybe if you invest it and save it, you're building your own personal wealth, but that doesn't do anything for the economy. Because if you think about the stimulus checks, when stimulus checks are sent out, who are they meant to stimulate? Now, you might think they're meant to stimulate the poor and the middle class, but that's not true. Because the goal of the stimulus checks are to stimulate the economy. How do you stimulate the economy? You give money to poor people, you give money to middle class people, and then you watch them spend it. So now, you give me money, I go to Chipotle, I go to Gucci, I go to Kroger, I go to Amazon, I go to Walmart, I spend money, and I stimulate the economy because now these businesses are making money. When these businesses make money, now they have more money to pay for more employees. They have more money to invest in more research. They have more money to open more stores. That is what stimulates the economy. And so now when JP Morgan is saying that there's $1.2 trillion of excess cash, that means people still have the ability to spend. This is why you have so many institutions saying, hey, we're still good in our economy. People still have the ability to spend because people are still sitting on this cash pile. People still have this excess money that they can spend. Once that money's gone, yeah, then we'll have something to worry about. But we don't got to worry yet because people still have this $1.2 trillion of excess cash. And what we've been seeing happen is that people have been digging into their savings to continue funding their lifestyles. Because one of the most difficult things for anyone to do is to reduce their lifestyle. Yeah, sure, the prices of things might be going up. Yeah, sure, you're not making as much money as you were before relative to the price of things, but you don't want to cut back. Instead, people will find a way to spend more. Maybe you dig a little bit into your savings, maybe you spend a little bit more on your credit card, and this is what we've been seeing happen. And this is why JP Morgan, Jamie Dimon, and many banks and institutions are saying, well, everything is good because the consumer is still strong. But now let's put this all together because, yes, consumers are spending more and faster than their wage growth. And then we have this excess cash pile, which needs and has the ability to still be spent, which can stimulate the economy. This excess cash is good for consumers, is good for individual people because now it can help you build your wealth. If you have extra cash, You can use the cash to build an emergency fund. You can use the cash to invest in a rental property. You can invest it in a business idea. You can invest it into the stock market. You can invest it wherever you want. You can use it to build your individual wealth, but that does not stimulate the economy. And so the whole idea here is that people have the ability to spend, and if people have the ability to spend, they will spend, and if people are spending, that's going to help grow the economy. If they continue to grow the economy, then the economy will still be fine, at least for the short term, because then people can still spend and grow the economy, even if the prices of things are higher, because people have the excess cash in the bank. That was when Jamie Dimon shifted to some of the new risks that we have right now in our economy, especially after this banking crisis that we have seen recently. And what he says is the new risks, in addition to the normal ones like a recession, are higher inflation for longer than what we expected, the market effects of quantitative tightening, that's what QT is, and growing political risks. Of course, I cannot be sure that this will happen, but I place higher odds on it more than the market. In other words, the new risks that we're facing right now in our economy, according to Jamie Dimon, are number one, higher inflation than longer. And this one is a huge point. And I've been talking about this for a long time. I'm sure you're probably annoyed by me saying this forever now, is getting inflation down to 2% is not going to be easy. The Federal Reserve Bank has almost already admitted that they are done fighting inflation because they believe they've done enough to bring inflation down. Now, I'm only saying this based off of what we've seen happen in history. And in the previous 6 decades, in all the times we've seen high inflation, in order to bring inflation down, the last notably extremely high inflation was in the late 1970s, early 1980s. We had to really jack up mortgage rates. I mean, back then, in order to bring inflation back down to reasonable levels, a mortgage rate jumped up to over 18%. If you wanted to get a home, you were paying 18.5% for a 30-year mortgage. So to bring inflation now from 6% or so down to 2%, it's gonna be difficult. And that's gonna take work. And this is where we are all hoping that inflation will come down easier, but the concern is that if inflation stays stubborn, either we're gonna have to settle for high inflation, which really hurts regular people, it hurts the middle class, it hurts the poor, or the Federal Reserve Bank is gonna have to get even more aggressive, which means more pain for the economy. And this is where also understanding the high inflation is slowing down the economy, while the higher interest rates are also slowing down the economy. So the effects of higher inflation for longer are going to play a big effect on the health of our economy and on the health of the consumer, because we're already seeing the prices of things rise faster than wages. And if that continues, well, it can only continue for so long until people say, I can't continue affording this stuff. The second thing is the market effects of quantitative tightening. Quantitative tightening is when the Federal Reserve Bank, who is our central bank here in the United States, is trying to bring down inflation by doing the opposite of what caused the inflation. So inflation is caused by inflating the monetary supply, meaning increasing the amount of dollars in our economic system. The way the Fed does that is through quantitative easing. Quantitative easing is by essentially opening up the money printer and allowing more dollars to flow into our economy, whether it's through stimulus checks, whether it's through more lending programs, buying more treasury bonds, just a way for the Fed to inject more money into our economy. Quantitative tightening is the Fed pulling this money out. Now, there's 2 essential ways that the Federal Reserve Bank currently is doing this type of quantitative tightening. Number one, which is the most talked about, is the Federal Reserve Bank raising interest rates, because when you raise interest rates, it makes borrowing money more expensive. It makes it a lot less attractive for people to borrow money. Like, less people are interested in buying a home with a 8% mortgage than a 3% mortgage. If mortgage rates drop to 3% tomorrow, you can bet that you're gonna see a whole new flood of buyers hit the market. So when you increase interest rates, that reduces demand, which reduces lending, which reduces new money entering the economy. So that's the first thing. When you raise interest rates, you reduce demand and you reduce the demand for borrowing money, which means less money entering the economy. The second type of quantitative tightening is when the Federal Reserve Bank is selling off some of their balance sheet. So during the 2020 pandemic, the Federal Reserve Bank jacked up their balance sheet. We saw their balance sheet go up to around 9 trillion some dollars. And what that means is the Federal Reserve Bank doesn't have cash reserves. They have the ability to print money. And one of the things that they do is they loan money to the government. And over the course of 2020 to 2022, the Federal Reserve Bank had grown their balance sheet, meaning the amount of money they lent out, by trillions of dollars, over $4 trillion. And so now, when you create that much money and put it into our economic system, in this case by giving it to the government, that creates more inflation, more money in our economic system. And so now when they're trying to do this quantitative tightening, what they're working to do is reduce how much money is in circulation, meaning by selling off some of these assets. So that's been a slow and ongoing process, not as much talked about, but they're essentially working to sell off some of their assets to relieve and reduce the size of their balance sheet. That is the second thing that Jamie Dimon says is a risk for our economy, because this fight on inflation is hurting the economy. The high inflation is hurting the economy. And then the third thing that he talked about, which was interesting, was growing political risks. And he didn't really specify exactly what that means, but if I had to guess, I think part of it would have to do with banking regulations, because as the CEO of one of the world's largest banks, if not the world's largest bank, he does not want to have over-regulated banking systems, because that would make it more difficult for his company to operate. And that's one of the things that he talked about in this letter. I didn't really touch too much about the banking regulations in this topic because I want to focus more on the economic side. But I would say that now with the bank failures that we've seen recently, that the risk and concern of banking regulations would affect the banking system, but also the tension in the country with the current political climate. And so naturally, as we're seeing a bigger divide between the rich and the poor, we're also seeing a bigger divide between the left and the right, which creates more civil unrest within the country. And so it's interesting to say and now see that Jamie Dimon says that the new risks to our economy are high inflation, quantitative tightening, and political risks. So, take that for whatever it's worth. Then he goes on to say that if this tide goes out, the tide of this growing economy and booming economy and easy money, you should assume that it will expose additional weaknesses in the economy. So hindsight is 2020. What will those weaknesses be? We will only see, because one of the things that he talked about, even with the Silicon Valley Bank dilemma, was that in hindsight, it was pretty obvious what the issues were, but you don't see those issues until after the fact. And so what he's saying is that with the growing and booming economy and everything still being great, if that tide goes away, we're going to see even more weaknesses, which is where he says that, based off of the information we have today, he says that we're going to see a soft landing. But when you see this type of economic slowdown, you can see much more weaknesses expose themselves rather quickly. This brings us now to the important parts, which is how do you actually fix the situation? And Jamie Dimon put out a 4-part plan, which I'm going to highlight briefly, and then I'm going to go into what each one of these things mean. Number 1, he says we need to build a United States growth strategy to grow our economy. Number 2, we need to build an industrial policy which, done properly, could drive growth and also protect our national security. Third, we need to fix our income inequality to reignite the American dream. And fourth, America must take the lead on devising a comprehensive global economic strategy. So number 1, starting with the US growth strategy, what Jamie Dimon says is we got to come up with a way to grow our GDP here in America, because we've been seeing GDP grow, but we've also been seeing inflation grow very quickly as well. And if we want to continue to be a strong nation, not just for the people here in America, but around the world, we have to find a way to grow our United States economy, grow the size of our economy. That way we can continue to build and grow and be the world dominating power. and he's going to build on that. The second thing is build an industrial policy which could drive growth and also protect our national security. And you'll see that with a lot of banks, BlackRock talked about this too, and a lot of banking institutions have been talking about national security as a core thing that needs to be done. And obviously there's a lot of concerns with what's going on in the other end of the world, with the Russian war in Ukraine, with everything going on in the oil market. We've been seeing a lot of tensions internationally. And, hate or to love it, the reality, I'm not saying this from an emotional perspective, I'm telling you this from a financial perspective. Wars bring a lot of dollars. National security, funding national security is a way to grow business or grow the economy, or stimulate the economy, I should say, because if you enlist more, let's just say army officers, that's more people that have to get paid. Now, how do they get paid? They get paid through tax dollars, or if the government doesn't have enough tax dollars, that money gets spent through the Federal Reserve Bank. But it's another form of stimulus from an economic side. But then from a political side, with everything else going on, you've been seeing a lot of banks and institutions talk about the importance now of building and improving the national security forces. Third, this one's interesting, which is fixing income inequality to reignite the American dream. Now, one thing that I want to say about the American dream, which I heard just a couple of days ago, is in a book that I was reading, which I found this statement very interesting. And what it said was, the only people that don't believe in the American dream are American people. People who are born and bred in the United States, because people who are outside of the United States, they see the American dream and they want to come here. So take that for what it's worth. But what Jamie Dimon is saying is we need to fix income inequality to reignite the American dream, because right now he's saying that some people are priced out of the market. They're not making enough money. They are struggling to survive. I mean, it's a common story. You know what I'm talking about with that. And there's a few things that he talks about that we can do to encourage people to become more financially free, to build this American dream back alive. And one of the things that he highlighted, the thing that he highlighted the most, was expanding the earned income tax credit, EITC. Essentially, create more benefits for employers, stop putting so many burdens on employers through taxes and taxes for people. Because when you're spending so much money in taxes, whether you're a business or a person, it's less money that you can use to either spend or to build your own wealth. If you are a consumer and you're spending more money in taxes, that's money that you can't invest into your own investment or retirement accounts. It's money that you cannot use to buy a home. It's money that you can't use to go out and do whatever. If you're a business and you're generating a profit, the bigger your tax bill, the less money you have next year to reinvest back into your company. So the way to fix the income inequality, one of the ways that he talks about, is to extend and expand some tax credits. And number 4, America must take the lead on devising a comprehensive global economic strategy. We need to stay the leaders in the global workplace as a global leader in the business space. And one of the things that he talks about is the power of artificial intelligence in a different section of his letter to shareholders, but saying that we need to continue being innovative, because we have the rest of the world that's working very hard to innovate, and the rest of the world has a target on our back, and the rest of the world is working to improve their education system, and the rest of the world is investing in innovation, and they're working to be the best, and we need to now take charge and do that tenfold here in the United States. Because if we're not innovating, if we get stale, if we get complacent, if we get fat, then that makes us an easy target for somebody else to come in and take over where we are right now. So based off of this information, what does this mean for you? Well, just like everything else that we've been saying, this is where now, number 1, financial education is so important. Number 2, be on top of what's happening, because the key factors you want to pay attention to are not the emotions and the panic and the sensationalism of most of the traditional media. You want to pay attention to what's happening, watch what the Federal Reserve Bank is doing, watch what's coming out in our economy, watch what's happening with consumers, watch what's happening with inflation, and see how these things play out, because there's a lot of risks in our economy. And we're going to see more and more of these risks play out over time, especially as interest rates rise. Of course, I'll be keeping you updated here on this channel, but Market Briefs is a free way for you to stay up to date on what's happening. And then third, you also want to make sure you are building your own financial cushion, not just to protect yourself, but also to capitalize on economic opportunities that might come your way, because the reality is market crashes and recessions create more millionaires than any other time. Why? Because when you see a correction or a market crash, it creates opportunity, because then a savvy investor can then capitalize on the economic slowdown, because when you see an economic slowdown, you see good assets go on sale. And by asset, I mean investment. And so if you can buy investments at a discounted price, especially if it's a good investment, that can allow you to build your wealth even quicker. But in order for you to do that, you have to work on being prepared, building that financial cushion, and also building that financial education. Our money, or at least what we call money, is being put to the test, not because of inflation, not because of interest rates, but because of something called debt monetization. Let me explain. Our government doesn't earn money. It collects money through taxes by taxing people like you and me. And in 2022, the government generated about $5 trillion